Hello investors, welcome to Simpli Stocks. So far, nearly 20% of the listed companies in the market have announced their December quarter or Q3 results. That is why in the first video of our Q3 FY26 results series, we will be discussing 4 small cap companies that have delivered very strong results. This result season is very important for investors because the market is currently highly volatile and is going through a bear phase. In such a situation, it becomes crucial to rebalance your portfolio and focus on quality business models. We will briefly understand the business models of these companies. We will look at their results and we will also try to understand their future outlook. But please remember, this video is strictly not a buy or sell recommendation for any of these businesses. Please keep that in mind. With that, let's get started. The first business we will cover is Manorama Industries. Manorama has been in my portfolio for a long time and we regularly cover it on our Simpli Stocks community and on this channel too. This company is a proxy FMCG player. It manufactures specialty fats and cocoa butter equivalents or CBE for confectionery, chocolate and cosmetic companies. These products are used as replacements for cocoa and other fats in those products. Pure cocoa is obviously expensive, so FMCG companies get a cost advantage by using CBEs as these fats are cheaper. Manorama manufactures these fats using mango, shea and sal seeds which they source from the forests of Africa and India. Talking about customers, Manorama supplies to companies like Mondelez, Ferrero, Nestle, L'Oreal and The Body Shop. The company has its manufacturing plant in Raipur. Let's have a look at the results now. In the months of October, November and December, that is Q3, the company's sales grew by a massive 73%, net profit increased by 131% or say more than doubled on a year-on-year basis. We also saw a slight expansion in EBITDA margins, which improved from 26.4% to 27.1%. Overall, even if we look at the 9-month performance of this financial year, the company has done very well. From April to December, sales grew by 81%. Net profit margin for 9 months stood at 17.8%. And if you can read here below, around 44% of sales came from India, while 56% came from exports, with Europe being the largest market. Apart from strong results, another positive development is that management has again increased its growth guidance for this year. After Q2 results, the company had raised its sales target to around 1150 CR. At that time, we had estimated that sales could reach around 1225 CR. Now, management has further increased the sales target to 1300 crore rupees, which implies a strong 70% growth compared to the last year. So, the company is also upgrading its fractionation plant through maintenance, which will increase capacity by 30% from 40,000 metric tons per annum to 52,000 metric tons per annum. This was expected in Q3 but got delayed because of some reason. Additionally, the company had purchased around 19.4 acres of land near its existing plant where it plans to add more manufacturing capacity. Management has announced a capex plan of approx 460 crore rupees over the next 2 to 3 years with expansion in India and partially in Africa too. So at a PE of around 35 to 38, you are getting a fast growing FMCG or proxy FMCG business which you can study further on your own. Manorama operates on a cost plus business model which creates a strong moat for the company. Cost plus means the company tells its customers that its costs are so and then adds a 40 or 50% or whatever gross margin on top of it. This model leads to higher customer stickiness and also protects the business from competitors. Now, just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video and yes, also subscribe to our channel. The next business that we will cover is Vintage Coffee and Beverages. We have been tracking Vintage also in our Simpli Stocks community for a long time now. When the company raised funds recently, we also covered it on our channel. Vintage is also an FMCG company, and as the name suggests, it is in the coffee business. It is a B2B player. That means it manufactures coffee for other brands and companies. The company is mainly export focused with only 10 to 15% sales coming from India. Its major markets are Southeast Asia, Russia, Europe, and Africa. The results have been very strong for Vintage too. You will see sales grew by 71% year on year to 151 CR this quarter. Operating profit increased by 83%. Net profit growth was slightly lower at 53%. As you know, new labor codes have impacted the bottom line for many companies. Plus, the company also incurred high costs due to new 4,500 metric tons plant, which is expected to go live by March. So these are very strong numbers. The company currently has an operational capacity of 6,500 metric tons for spray dried and agglomerated instant coffee. An additional 4,500 tons capacity will become operational by March, taking total capacity to 11,000 metric tons, which is 70% increase. Management has confidently stated that they will reach 70 to 80% capacity utilization in the first month itself and move to full capacity utilization by second or third month. So this new capacity should drive strong earnings growth in FY27. Beyond this, the company is already planning for next year as well, and this is something I really like about Vintage. It plans to add another 5,500 metric tons capacity in Telangana, which will be for premium freeze-dried coffee, which offers better margins. So over the next 3 to 4 years, the company aims to reach a total capacity of 16,500 metric tons, which gives a good visibility of 40 to 50% CAGR growth over the next few years. But for Vintage, there have been some reservations around promoter shareholding. So let us talk over that too. The company has been raising equity to fund capacity expansion so far, which diluted promoter holding. But going forward, funding for freeze-dried plant will be through debt and not equity. So promoter holding should remain stable. So Vintage Coffee is a good FMCG business that you can look at. Valuations are very attractive right now. The stock is trading around 32 PE, you will see. After Manorama and Vintage, we will now study two jewelry companies, PC Jewellers and Thangamayil Jewellery. Before discussing them, let us address a very important question. You see, gold prices have gone up sharply. So everyone is worried whether this negatively affects jewelry retailers like PC Jewellers and Kalyan. Is this the reason these stocks have corrected so much? So take it this way. You would know that jewelry companies do not make money from gold price movements. They earn through making charges. When gold prices rise, making charges in percentage terms also increase, which leads to value gains. When gold prices fall, people tend to buy more gold, resulting in volume growth. So does a sharp gold rally mean people will stop buying gold? I don't agree with that, honestly. Some purchases may get delayed, but jewelry retailers also run gold schemes to reduce the impact of that. Plus, Indians have a very deep cultural and emotional connection with gold. We view it from both points of view, as a status symbol and as investment. In fact, see, rising gold prices reinforce the belief that gold is a good investment. Short-term demand may soften for few months or quarters, but long-term outlook remains very, very strong. Indians will continue buying gold for decades to come. And on the other side, what has happened is, due to negative sentiment, jewelry stocks are currently trading at very low valuations. Another interesting point is, I don't know what sort of negative sentiment it is which has not affected the market leader. You see, Titan has not corrected much, while others like Kalyan and Gadgil have corrected. So overall, gold price rally does not significantly hurt jewelry businesses. Sales and profit growth has remained very strong here. Now moving ahead, PC Jewellers Q3 sales grew by 37% year on year. Gross profit increased by 63% and profit before tax rose by 29%. We are not focusing on net profit because PCJ has moved from losses to profits and there are tax adjustments. So overall, the business is clearly moving in the right direction. PCJ has also been aggressively reducing its debt and aims to become debt-free by the end of this year. They have around 55 stores, I think, of which about 5 are franchisee stores and the rest are company-owned. Over the next 12 to 18 months, the company plans to aggressively expand its franchisee model with an upper limit of hitting 100 stores. Overall, PC Jewellers has delivered, I will say, good results and is in the value zone. The stock is trading at just 11 to 12 PE ratio right now, and even a small re-rating can lead to good uptrend here. Let's also take a look at Thangamayil. Thangamayil is a regional player with 66 stores in Tamil Nadu. Compared to players like Kalyan and Tanish, who focus on lightweight and lifestyle jewelry, Thangamayil has more presence in pure heavyweight gold jewelry because that is what gets sold most in Tamil Nadu, right? Thangamayil sales have also been very strong. As you can see here, sales have more than doubled compared to last year, growing by 112%. On a 9-month basis, sales growth stands at around 60%. Net profit has also increased sharply, up almost 120% year on year. Another important point here is that strong growth in sales and profits has not only come from gold price rally, volumes of gold, silver and diamonds have also increased. This means the company sold more gold compared to the last year. So we can say that despite higher gold prices, Thangamayil's customer base continues to buy gold in large quantities, which is a very good sign. So overall, these are very strong numbers. From a long-term perspective, I am personally very bullish on the jewelry sector, and I believe this is a sector that will continue to grow well in India for many years to come. Now, at the end, a humble request: if you did not like the video earlier, kindly do it now. Along with that, you can also subscribe to our channel Simpli Stocks, because if you support us with your likes and subscribes, we will be able to bring more such videos for you every week. So I will see you in the next video. Happy investing.